In 2023, I met with an Indian equity manager in Mumbai. He told me India's equities could face a massive sell-off, he said. Money could flow back to China or US Treasuries if government spending slows in India or if China launches an aggressive expansion plan. At the time, it sounded like a contrarian call. After all, India was the hottest stock market of the decade. But eventually, he was proven right. For most of 2024, India's stock market seemed unstoppable. The Nifty 50 surged to an all-time high. With China struggling and Russia cut off from global capital, India became the go-to market for foreign institutions investing in emerging markets. China's real estate crisis was out of control. Developers like Evergrande teetered on collapse, housing prices stagnated, and consumer confidence crumbled. Deflation took hold. Households chose to save instead of spend, fueling economic stagnation. Capitals fled from China. The yuan hit multi-year lows, and industrial overcapacity crippled China's recovery. With China in freefall, India looked like the only game in town, until September 2024. But then, everything changed. That's when China flipped the script. A $500 billion stimulus package and the promise for more reignited investor confidence. Foreign funds pivoted back to China. Indian equities stalled as expensive valuations became impossible to ignore. And just as capital flowed into India when China was struggling, the reverse happened when China rebounded. But the Chinese stimulus was just the catalyst. India was facing its own challenges. Government-driven infrastructure spending slowed post-elections, cooling off economic growth. Consumer demand weakened. Despite strong macroeconomic indicators, the result, a perfect storm of selling pressure. Foreign investors weren't just leaving for China. They were seeing domestic risks piling up. For this reason, they also chose to invest in treasuries. China's stimulus might have triggered the shift, but India's slowing momentum sealed the deal. When foreign money rushed out, India's stock market faced its biggest test since 2019. The banking system struggled through its worst liquidity crunch in 15 years. The Reserve Bank of India stepped in, but the outflows were just too big to contain. So the Indian government had no choice but to act. A major stimulus was announced. The 2026 budget focused on reviving domestic consumption, rolling out a 1 trillion rupees tax cut, expected to boost salaries by up to 9.5% over the next 2 years. With this shift, India's growth story is evolving, pushing focus onto key sectors. Rising incomes and government incentives will further accelerate car sales, with a strong push for electric 2- and 3-wheelers. With Make in India policies, investments will keep on flowing into semiconductors, solar panels, and high-tech industries. India's pharma exports keep expanding, cementing its role as a global leader. Last but not least, the drive for energy security is fueling massive investments in power grids and energy storage. So where do we go from here? Right now, Indian equities are still in a downturn. But if history tells us anything, markets reset and new winners emerge. Plans are nothing, but planning is everything. That's exactly why we take a dual approach, balancing macro analysis and market momentum. Understanding economic cycles, policy shifts, and key growth trends is as important as respecting market momentum and technical analysis. Estimating entry points and trend reversals increase discipline, and discipline reduces risk, the goal. To be ready when the market turns. Stay tuned or contact us for in-depth reports on this and other topics. Contact me for premium research packages, or subscribe for more highlights from my trips.